Today's market call is presented by Robinhood. Take charge of your trades with Robinhood's powerful new free desktop trading platform, Robinhood Legend. While there is no cost to use the Legend platform, there are other fees associated with your brokerage account. See the Robinhood financial fee schedule for more information. Tuesday, Feb 4th, the month is flying by. It is 1 o'clock on the East Coast. Dan, Nathan, Guy Adami, market call. How are you, Dan?
I'm doing great, Guy. A heck of a 24 hours in the markets. It seemed like doom and gloom on the Monday morning, which is actually the second consecutive Monday morning where things seem to be, kind of shaking the foundation of this market. And the reason I say that is last Monday, a week ago Monday, it was kind of, shots across the bow of the generative AI trade. And then yesterday was kind of the really first day, I think, since inauguration, or actually since, Trump was basically detailing policy that he was going to put in place, where the market participants got a little squeezy or a little jittery about what those policies might be,
No question about it. But as we're sitting here with the S&P at, 6028-ish, I mean, we're within 1.5, we're within 2% of an all-time high. So, all these things get thrown at the market literally, seemingly week after week, to your point, and market shrugs it off like a champ. So we'll see. And, again, these volatility days are lasting a day. And here we have a VIX right back below 17.5. And we'll talk about all those things. But, to your point, I think it speaks to, once again, this continued resilience in a market that I think a lot of people would agree is expensive. There are a lot of reasons to be concerned, yet here we are sort of grinding higher.
Yeah, we're going to use that legend that you just kind of introed this show with, Guy. That would be the Robinhood Legend, to detail a couple trade ideas in the options market. One is actually a hedge in the SPY. We'll get to that in a couple minutes. And then another one is in a pharma stock that you've had your eye on. It's one that you hold near and dear. And we'll get through that a little bit. But I don't know. Let's talk about the kind of tariff trade war, the back and forth. Trump said, I guess, yesterday in the Oval, well, it's a negotiating tactic. And then he launched into some, back into the kind of trade situations and the deficits and the like. I think we have the playbook from Trump 1.0. We know that, he and his advisors think of these as a tactic. And we also probably know that under certain circumstances, they will stick with them. I guess the ones that I'm probably less likely to kind of buy into are the ones with our allies, right? And so it's interesting because that's really what's played out over the last 24 hours. They were scare tactics with our allies. This would be Canada and Mexico. Both did something to appease, you know what I mean? Whether they stick with it or not is another story. They don't really do much to kind of counteract the trade imbalance that Trump is supposedly really focused on. But it's the Chinese ones, I think, that are probably most interesting and more likely to stick.
Well, that's the one where there could be, retaliatory or, a tit for tat. The others clearly, just want this to go away, which I totally get. And, but to your point, I think for the foreseeable future, and when I say the foreseeable future, I would imagine, until May or so, you're going to continue to see headlines that send the market one way, and then obviously ensuing headlines that send the other way. And I do think volatility is going to be the norm for a while. But what's amazing is, the sell-offs don't last. And, there was some concern. I mean, at one point, I think the S&P was down 125 or so handles, and it cut it in half. And now here today, we're getting a lot of that back. And, by the close of today, we could have gotten it all back, which I think is really amazing given some of this rhetoric that's being thrown around.
Yeah, and what's also amazing is that if you think of these two sets of threatened tariffs, obviously one against a adversary politically, and then another one with two countries that are our two biggest trading partners, two huge allies of ours, those would be the ones that I think would do more damage to the U.S. economy. Those are the ones that I think would actually really do damage to the global economy. Because if you start to have our allies, both, here on our continent and abroad, let's specifically say Europe, start to question our, commitment to these, longstanding, trade relationships among allies, that's the one that's going to do some damage. And we talk about this all the time. When you think about, this expected earnings growth for the S&P 500 of 13, 14% or so, those are the things that could become massive headwinds to earnings growth, right? And then if you think about the dollar where it is and interest rates, these are all headwinds to U.S. corporate earnings, especially the ones that sell a lot of stuff overseas.
Let's throw up the slides that Amanda made because they are some really nice. I mean, she does great work, Amanda. Just to sort of, give some context as to what we're talking about. I think the market was sort of startled by the Canada, Mexico, to your point. I think China was, to a certain extent, I think people expected. The China, Mexico took people off guard, which is why we saw the sell-off in the market. Then within the day, you saw Mexico acquiesce. And I don't want to get into whether or not they're just doing what they promised to do all along. But I mean, there were headlines to suggest exactly that, and Canada as well. And the market took a breather from there. China's a different story. And if you look at the next slide, I mean, it speaks to exactly that. This is where things could get interesting, I think. And this is where I don't necessarily know that the market is fully pricing in the ramifications if, in fact, this thing were to be escalated.
Yeah, and I guess the takeaway I have is that a number of the stocks here in the U.S. that got nailed yesterday because of the threat of these tariffs, again, all over the world, if you think about it, the bounces are not that, they're not that impressive today. And like, look at the autos, look at some of these other areas, industrials that got hit. So to me, I just think that, again, you got to take stock of what was moving yesterday, what were the knee-jerk reactions, and how they're bouncing today. And, we can go back to last Monday and Tuesday and think about how generative AI stocks, or, a lot of these big hyperscalers and the chip names, how hard they got hit on Monday and the sort of bounces that they had on Tuesday and the rest of the week. So similar sort of price action. Look at the names though in the K-Web. These are Chinese internet stocks. I mean, they're having a day here. And I know this is an area that you kind of have been a repeat buyer of the BABA. You thought it got too cheap. And again, that Chinese consumer, while, they're not the sort of consumers that we are over here. These are kind of, mainstays. These are services that they use a lot, and obviously a lot of goods that are sold there. There's trade or tariff implications there. So big bounces. Hard to chase these though, Guy. When you think,
well, yes and no. Throw up an Alibaba chart, and we just had Vinny and Porter on our show we were down in Florida, and they talked about Alibaba being a trade, and I agree with them. And what's amazing is this was a story, obviously, in the fall. David Tepper spoke to that. It round-tripped the entire move, and now we're back on the horse here. And I'm one of these people that think, and I've thought it was correct for a period of time, been wrong for a period of time, but I think Alibaba, when it was trading $80, was about 40 or so percent, if not 50% too cheap. So here we are approaching 103. I think it's going to challenge those levels we saw in the fall of last year. As you know, Dan, BABA is the B in my tube, and that's gotten off to sort of a rip-roaring start. We'll see how long it lasts. But, these Chinese stocks, somewhat counterintuitively, could be a place to sort of hang out for a while.
Yeah. And again, valuations, and, if you did have like a de-escalation of the trade situation, again, they probably start to work. But, the way I look at this trade, it's really more about China consumption than it is about tariffs. And so, again, we'll see how this plays out. Which brings us actually, Guy, to the S&P 500. You just mentioned that, we're only down about 1.5% from those previous all-time highs. We did not have a breakout after that big bounce back, that V reversal in January. We made a slight new high, but then if you look at that, we're in a bit of a little downtrend there, Guy. You see that uptrend that has been in place. You see how it touched that January low. You probably get yourself to 590 or something like that. That's kind of the first level of support there. You see that resistance level there up at 610. I'm really focused to the downside. That something looks like that kind of 560 level. That was the breakout from September. That was also where the 200-day moving average kind of lines up at. So to me, I just think there's more risk near term to the downside because of that uncertainty that you just mentioned on policy as we get out of S&P earnings. You know what I mean? A lot of folks are going to kind of rejigger maybe their forward earnings estimates, and maybe there's a turn that comes off the multiple because of weakening growth. Then you got rates, then you got the dollar, you got a whole host of things that, to me, I just feel like this could be setting up for a good trade down towards like 560 or so.
And we're going to outline that. And here is, here's the static chart, and Amanda drew the lines. But if you were to put up a current chart so we can draw some new lines, this is one way to look at it, and that support that you outlined is right. Another way to look at it is to draw that first low, and then draw the connecting points off the, I guess, sort of mid-September-ish. So if you sort of just move that trend line up, what you'll see is there was a trend line in place for a long period of time that was subsequently broken. We moved, traded back up to it and failed. And now we're sort of dealing with, all right, how are we going to look at this entire thing? So that bottom line, that bottom point there, Amanda, now go down 1 month, yeah, and then connect those points, and you'll see exactly what I'm looking at. So that was a trend line that was in place that was subsequently broken. We traded back up to it and failed, and now we're trading back up to it again and theoretically failing. And as Carter points out all the time, that actually potentially could be, a really negative setup in the fact that we broke an existing trend up, traded lower, traded back up to the trend line and failed. That's the way I look at this as well. So, same chart, looking at it two different ways.
Yeah, well, that was a trend line we were tracking, and to your point that that ends up being resistance as it broke below it, it bounced back there, and so here we are in a little bit of a downtrend. One of the things, Guy, when you and I were talking about some different trade ideas earlier, the idea that the S&P is going to lose a little steam here, given the uncertainty, it got kind of out of the gate with some pretty good earnings, I want to say a few weeks ago, starting with the banks, and then we've had some mixed results in tech. But we're going to be through most of S&P 500 earnings by the end of the week, and then we know on Friday we have the important January jobs number.
You just like saying that, the all important.
I know. 17.5, or we're really at a 17 VIX here. Maybe Amanda wants to pull that up correctly. You could make the argument that that it's not priced appropriately given some of the recent volatility we've had, given some of the uncertainty that we're going to have as we get through some of the macro data. Right when we get through the job stuff, we're going to start getting inflation data again. We know we had that PCE that basically came in line. But to me, this sets up pretty nicely. If you're looking at the SPY and you're considering a hedge near term, or you're considering an outright bearish bet, this kind of looks interesting to me, the setup here. So I want to look at a put spread. I want to go out to March quarterly expiration. So that would be the last day of March 31st. And I want to kind of target to the downside that area that we just spoke of, that sort of 560 level, which matches up with the September breakout, also matches up pretty closely with where that 200-day moving average that's been rising. So today when the SPY was trading at 601, and maybe Amanda, let me drive for a second here. I want to go to the options chain, and I want to go to March 31. This is the SPY here. In the middle of this option chain, you see basically where the ETF is trading. We priced it up at 601, but if I'm looking at a put spread, and I'm looking at March 31st expiration, here I am. I'm going to just show you how quickly you can kind of change. Those are all the expiries right there. So I'm going to go March 31. I want to focus on this at the money put. So this is the 600 put. It offered at about 1133 or so. So I click on that. Then I want to go all the way down to this 560 strike. Okay. And I'm going to be selling that, right? So if I'm buying one of the March 31st 600 puts and I'm selling one of the March 31st 560 puts, well, actually, I'm going to go to 555 on this one. I'm going to give myself a little room here. Give me a second. See how easy that was? I made a put spread, the 600, 560, and I just X'd out of the 560. So here we are with the 555, 600 put spread. If I'm paying about $11 for the at the money and I'm selling the way downside to 555 at about $3, it costs me about $8. Right here, it's priced up at $8.30. So how do I make money on this? I take the premium that I paid, which is about $8, right? And then I deduct that from the strike, the 600. So my break even is down at 592. My max gain is down at 555 on March 31st quarterly expiration. I'm risking that $8 to possibly make 37 if the ETF is down 7.5% or so. And when you think about that, it's kind of interesting, right? So I'm risking 1.3% of the ETF price. It breaks even down 1.5%, and I have a max payout of 6% on March 31st expiration if the SPY is down 7.5%. I like the risk reward there, and like all long premium directional trades, I'm going to use about a 50% premium stop, Guy, on this trade idea.
If you look at this and go back to the chart, so excuse me, that's the structure of it. But you'll see you're taking advantage of this recent bounce. You have volatility effectively working for you because you're obviously the big cost is the put buy of $11 or so, right? So you're taking advantage of the lower vol, and you're looking for a move into the remainder of earnings that sort of makes sense into a March, which for a lot of reasons could be, pretty interesting in terms of volatility. So it makes sense to me. And when you have like a 4.5 to 1 potential payout, or the risk reward is 4.5 to 1 in your favor, it probably, listen to me, it makes a lot of sense, especially given my proclivity to think things are a little rich here.
Yeah, no doubt. And again, I just think that this comes down to a couple things. It comes to headwinds to S&P 500 earnings growth that might be apparent as we get out of earnings season, and then some of the macro as we think about the jobs report, and then some other of the inflation data. Guy, this brings us to earnings volatility. So we talked about the lack of volatility in the major indices. Just look at today, a little bit of a snapshot of some companies that are reacting to earnings. The Palantir beat and raise, high expectations. We don't really got to go into that one too much. It seems to be like a meme stock in the generative AI space. They're putting up big numbers, or putting up big growth numbers, but the numbers themselves are not particularly that interesting, trading about 50 times sales. You made that point. And then Spotify, here's a name that's been working, also a more reasonable valuation, a good secular story. Also, look at that move. And then you got a bunch of these ones to the downside. When you see this sort of volatility with a half a dozen names post earnings, Guy, what's that saying to you about the volatility bands? Either way, up or down, they're getting widened.
Yeah, well, to me, when you're seeing individual stocks move the way they are, and these are not small companies. I mean, Pepsi, for example, is a $200 billion market cap company. Merck is a large company. I mean, we mentioned Spotify. We mentioned Palantir, which, by the way, Palantir is now going up to about $220 billion market cap company. So it's remarkable to see these individual names have the volatility bands that they have. And it doesn't make sense that the broader market vol is still sort of anchored around 17 or so. At least it doesn't make sense to me. But then you try to figure out what's going on in the world. And, yeah, we have Pepsi on the list. So let's throw a Pepsi chart up real quick, because what you'll see here is a stock that made its all-time high in the spring of 2023. And think about what was going on. Inflation was obviously moving to the upside, scaring a lot of people. They were able to not only pass on the costs, but take advantage of it in terms of margins. That stopped in the spring of 2023. And ever since then, Dan, the stock has not traded particularly well because, in my opinion, for a lot of different things going on, GLP-1's probably one of them without question, but, they're no longer able to pass the cost on, and their margins have been affected. So, you think about a broader market, as we said, at an all-time high, and here's a stock that has not participated now for almost going on 2 years.
Yeah. It has something to do with also that really kind of narrow or declining revenue growth, low single digits, earnings growth, kind of mid single digits. And you say to yourself, okay, this used to trade at a big premium to the market. You remember that? Like a lot of these expensive consumer staples, and now it trades at a big discount. So that makes some sense, but it almost feels like a bit of a value trap. But I think I like the way you kind of worked in that whole idea of inflation. It was working well for a while, and now they're no longer able to kind of pass through those costs. And I think that's going to be a big story, Guy, of this year. As you think about a lot of the hopes of the markets, the way it was rallying is that we were going to get rate cuts because inflation was coming down so dramatically. You made the point again and again, on a cumulative level, that's the thing that's hurt a lot of U.S. consumers. So all of a sudden, if you're getting pushback about, kind of the pass through of increased costs, well, all of a sudden that could just lead to less demand. Less demand means lower margins. Lower margins means less earnings growth, right? So like that could be the story of the S&P this year. I think there's a lot of bulls out there who think that inflation's tame. Interest rates are probably going to come down more than expectations are right now, and the market's going to be priced to go higher and kind of grow into that forward multiple.
That's the rub, right? So, I mean, we're going to see. That's why markets are so fascinating, because people can look at the same set of data and come up with different conclusions. What's interesting, and this sets up our next trade, is what's going on in healthcare. So if you want to throw up an XLV, and we'll sort of walk you through this. I mean, this has been in a pretty decent downtrend, as you can see in that channel, that theoretically has been broken. 200-day moving average right around. It's sort of flattening out. If you go to the next slide, you'll see what we're looking at here in terms of the band that it's been in for a longer period of time and the potential for this thing to break out. Now let's look at the next slide, because this speaks to how this thing is weighted. Obviously, Eli Lilly is a big component of it. I think we all know that. Lilly's done well over the last year, but there's some outliers in here. And the one that sticks out like a sore thumb is the fact that Merck is now down 30% over the last 12 months, and obviously cascading lower today on the back of an earnings release, by the way, which wasn't bad. It was a commentary around Gardasil and what's going on in China that spooked some people. So you're going to have a huge volume day today in Merck to the downside. I think a lot of people are just sort of throwing in the towel. And for me, Dan, given what we just looked at in terms of the XLV theoretically breaking out, I think that there's a trade set up here in Merck.
Yeah, and again, you know, I'll take your lead on this because we've seen this again and again. You have a stock like this was much loved, what, about a year and a half ago?
$130 stock, seemingly, you know, couldn't get out, you know, could not stop it. And then obviously things have gone the other way. I think a lot of it has to do with some concern around some of their existing drugs like Keytruda, when they're going to come off patent, and obviously the things they're talking about today in the form of Gardasil, without question. But again, you know, sometimes when you have days like today, and if you go back and we'll throw up a Merck chart real quick, you know, we're trading at the levels that we broke out from to the upside in September of 2022, when the stock was basically trading around 87.5, 88.
Yeah, I look at a name like this, and it's just so interesting to me how investors, you know, just get so on board one way and then so off, you know, off sides the other way. And this is a big technical breakdown. This is a huge gap on big volume, you know, below what you want to call a support level going back, you know, till mid 2023, right? And you say to yourself, okay, let's look at the potential earnings growth. What gets discounted from here? Right now, for this current year, expectations are 20% year over year. Now that comes off a year where things were declining, but let's just put a haircut on that as far as earnings growth, right? And sales growth, mid-single digits, is a company that, again, has a great balance sheet. Maybe you don't care that much about margins, especially if you have some of their killer drugs coming off patent, but it's still an 80% gross margin company trading at less than 10 times this year and less than 9 times next. So this is almost one where you want to maybe take the view that market participants are kind of overdoing it to the downside on one tape bomb, and maybe it sets up for a bounce back towards that breakdown level and a little higher where it was trading last week. So this is the perfect sort of example of a stock that you probably want to define your risk in, partially because what we just said about the technicals, but also the uncertainty in and around the financials. So today, when the stock was trading around $89, and let maybe Amanda will let me drive, we'll put this up for a second here. $89. I was looking out to April expiration, the 90-100 call spread, 280 for that, buying one of the April 90 calls, paying about $350, selling one of the April 100 calls around 70 cents. That premium that I'm paying, $2.80, that is my max risk on the trade, about 3% of the stock price. It breaks even up about 4% with a max gain of about 8% if the stock is 12%. So I can make 8% of the stock price if it's up 12% between now and April expiration. And I like that risk reward here. So let me go. They're going to let me drive here, and I'll show you how I would build this. I'm going to go to April expiration. I have 72 days for this to work out. Right now it's trading, you know, closer to 90 here, but I'm going to look at a call spread. And so that 90 call is offered at about 370. And I'm going to look to that 100 call and selling that. Well, there you are. You have this thing. It's priced at about 290 right here. We priced it up at about 280. I just kind of like the risk reward. You know, usually when you get a big gap like this on volume, sooner or later, you're going to have some folks coming in and saying, you know what, the story looks a bit overdone. The stock is cheap. Maybe there's some catalyst in the next couple of months here. So I'm going to take a crack on this. I like the idea of risking about 3% for a 12% move between now and April expiration.
Yep. And, you know, just to throw a little more fuel for the fire, they announced I think a $10 billion stock buyback, which doesn't sound that interesting, but you know, if you read between the lines, what it says to me, I think, is they're not going to sort of go out on a flyer and buy a company and overpay for something. They'd rather be buying stock back here, which I think should assuage some of the concerns that people have that they might buy something and overpay for it. So we'll see. This is a great way to construct this trade. As I've said before with trades like this, if you want to leg into it, that's fine. If you think this stock is bottomed, you can buy those 90 calls for, you know, 3.5 or whatever the price was last that we looked at it. And you can wait maybe potentially to sell the 100 call if you get a bounce, and instead of selling it for 70 cents, maybe sell it close to $1 or $1.10 or something. So that further mitigates. But that's, again, a different way to enter the same type of thought process of the trade.
Hey, Guy, let me ask you this. You and I grew up in age, I want to say the late 90s, 2000s. There was a lot of M&A in and around pharma space. And it seems like big M&A just went away for a while. This is a $225 billion market cap company. It trades really cheap. It's got a really good balance sheet. I think, net debt is something like, I don't know, $24 billion on a 226 billion market cap. So it's got an enterprise value of about 250. Are there any blockbuster deals? Because think about it. One of the big things we kept on hearing about this pro-growth sort of agenda by the new administration is that M&A could be unleashed. If you have American companies like Merck, great American companies, and Pfizer, right? And they're just maybe we can pull up a Pfizer chart for a second here. These companies are doing, they're having a hard time, right? And so I just wonder, are there any massive sort of pharma deals to be had?
Yeah, and you throw Bristol into that. I hear what you're saying. I mean, but I think the market probably would not look favorable to sort of a merger of equals type things, if that's what you're saying. I think there's more, I think, credence to the fact that all of these companies, Bristol, if you're not named Eli Lilly, these companies are looking for, where can I find the potential next blockbuster in the form of some of these smaller biotech stocks? And we've talked about Viking Therapeutics, which, by the way, has absolutely fallen off a cliff. Summit Therapeutics is another name. So a lot of tuck-in names that potentially could pay huge dividends, but I don't see, and I don't think you're suggesting that sort of Pfizer and Merck or Pfizer and Bristol or any of those three sort of figure out a way and say, you know what, let's pool together and see if we can figure that out. I mean, to me, that's just sort of hoping the two negatives equals a positive. I don't think it's going to work out that way.
Yeah, that's a good way to kind of put it. So that makes sense. I just, what? It's funny. There was so much M&A in the pharma space.
Yeah.
I just remember days past here. All right. Well, now we got some earnings, Guy. Tonight, this is not a week that you want to kind of blink at because there's some stuff going on that could really, I think, dictate at least some of the momentum in the generative AI trade, if you will. What do you want to go to first?
Let's go to Google. I mean, I think that's one that people obviously know pretty well. I mean, we've talked about this story over and over again. I think we know the pros with Google. I think we understand the valuation has always been reasonable. I think one of the concerns is, and you've talked about this, as much as AI could potentially help some of these other companies, is that sort of a potential headwind or, I don't know, existential risk for a name like Google. I don't think, by the way, it's going to play out this quarter or next, but that's out there. And I think one of the reasons it doesn't trade at the valuation of some of these other names is because the market doesn't believe the moat that they've enjoyed is as wide or as deep as it probably used to be.
Yeah, it's not too different than the way we talked about NVIDIA when you own the market share in one huge business, right? And people talk about Google, they've had this massive market share of one of the best business models that has ever existed, which is digital advertising, right? The leverage that they get off of, serving these ads and, just being the main portal to the internet has been a great thing. But what's gone on with these generative AI, these large language models, I mean, folks are going to those user interfaces and they're getting far better contextual answers rather than getting a bunch of blue links. So Google for the last 2.5 years has been introducing different iterations. It started out as Bard, then it was Gemini. That's the thing, their large language model that they're trying to integrate across a lot of their products and services. It just hasn't been as good as some of the other competitors here. So the fact that the stock is trading at an all-time high today, right before they report earnings, and given all the headwinds with DeepSeek last week and some of the advances that OpenAI is making, and there's other models too, they're going to have to demonstrate a couple things in this quarter: that they're not seeing a deceleration in Google Cloud. That's where a lot of their customers are going to access a lot of these generative AI models to build on. But then also, more importantly, their search business, to your point, is there an existential risk that these other interfaces, these other models are going to start chipping away at that monopoly. So we're going to get a better sense quarter over quarter about what this sort of looks like. And on a sequential basis, this is really interesting to me because this is where all this innovation is happening real time. Carter likes the chart, likes the breakout. That was a nice little flag. If you go back a couple months and you look at that gap and that 2-day move, that was based on a piece of news that you and I were scratching our heads at. It was some advancement that they made in a quantum computing chip. This is not a technology that they're going to be using anytime soon, for whatever that's worth. So I don't love the setup into the print. I mean, I would have said that. Pull up Palantir for a second. I would have said that yesterday. The stock's up 20% today. It's just not my game. I cannot buy stocks that have had these great moves at all-time highs into a piece of news that could be somewhat binary. And I don't mean binary to the tune of up or down 20%. I mean to the tune of, that 6 or 7% or outperforming that implied move one way or another. So again, that's a beautiful breakout, but like, who the hell is buying that here other than a short?
Yeah, well, Palantir is its own story that, as you mentioned earlier, the market cap, and you probably have in front of you, I'm guessing, though, it's probably about $220 billion or so, that a company that's going to do maybe $4 billion in revenue, throw on the fact that they probably have $5 billion of cash, round that up to 10, and you can do that math. I mean, it's trading north of 20 times sales. So, that's just me. Sales plus cash. I think it's expensive. Huge volume day. I wouldn't be chasing this. Google, if you want to throw it up real quick before we go to AMD, here's my concern. I mean, Apple, people were sort of excited about the quarter. Obviously, the aftermath of the conference call, the stock spiked higher, subsequently traded lower. The Microsoft quarter, obviously, I think caught people off guard. You saw how poorly that traded. So a lot of these big cap tech names have not traded, and you throw NVIDIA in the mix, have not traded particularly well post earnings. And one has to wonder if Google's going to sort of be insulated from that or going to fall victim to it. So I'm with you. I know what Carter said yesterday. I respect that, but I'm not chasing it here, I don't think.
Yeah, I mean, I think the risks are greater than the reward, because I think that if you have a beat and raise, it speaks to, I just think, like, a lot of the stuff that we already know about this business model, but it doesn't give us a strong sense of like what that sort of cannibalization might be in the future. They're already doing overlays, contextual overlays to your searches. I just don't find them nearly as good as, let's say, OpenAI. They will catch up. There's no doubt about it. And I think that's the bull case for the story. You think of the breadth of their properties and the billions of people that they have on each one of them, that they're able to figure this out using Gemini across all of these big platforms. I think it's going to be a home run eventually. I think the near term, it's probably risk, but if you have a beat and raise, you could have this sort of scenario like we saw last week with Apple guy. It gaps up, and then people are like, this is as good as it gets for the near term, and then you have some selling into it. But again, it just depends on your conviction. I'm just not that convicted. I'd rather make a move after I see the news, because I think if it's a guide down, I think you'll short every uptick. And if I think it's like in line to maybe a slightly better guide, I think they sell that too after a gap.
Yeah, well, I mean, it's always fun to see what because the stock does move, which is interesting. Let's go to AMD real quick, because this has been a disaster now since I think March of last year. I mean, it's been in this very defined downtrend. I was hard pressed to understand why it rallied the way that it did. So that caught me off guard. But the fact that it's been cut in half since then, I think actually sort of makes some sense. Now, I'm not saying you should short AMD here, but if I'm being 100% honest, and I've been saying this for a while, I think the ultimate level this thing finds a home is around 97 or so, which if you go back and look, that's sort of where we broke out from in the fall of 2023. So a round trip in AMD on the back of valuation and on the back of the fact that, they're probably not in the game as much as the market thought a year or so ago makes sense to me.
Yeah, and if you're looking at this on a 1-year basis, you say, well, it's spending some time near these 52-week lows. It's also back towards that low that we saw in early August. I mean, from a technical perspective, I don't know, have a ball. Let's look at the 5-year. Maybe it gives you a sense of like where it could go. There's a level much lower, if you want to just kind of look at that really quickly, and maybe it looks towards $100, So the implied move of 8%, if you're convicted one way or another, 4% is the at the money call, 4% is the at the money put. There's just no support, to that $190 level. It's not like this stock trades so cheap either relative to what they've been saying about the TAM, the addressable market in generative AI chips. They just have not come up with anything at scale that compete with NVIDIA. They have some chips that have the performance of some of these high-end GPUs that NVIDIA make. They're just not getting them out in scale, and they just don't have the backing of some of the big buyers yet. So I know for a fact, as you do, Guy, a lot of these big customers of NVIDIA would love a second source. They would love the opportunity for AMD to compete on price. They just don't have the product right now and the scale in which they do. So this is not one. Could this, if slightly better, results at a guide higher, Would it gap? Sure. It's up 6, 7, 8% or something like that. But I don't think you see a lot of follow through.
Yeah, I'm with you on that. Real quick before we get out of here, Gary Webb's asking about Disney in the earnings. I think the stock traded about the 124. I think probably trading about 113 now, if I'm not mistaken. How's it set up in the earnings? I look at this, and if you want to sort of go out a little bit, it seems like, to me at least, we finally have turned the corner. And so you've gone to this sort of bearish, potentially to bullish reversal. Now, in order for this to continue on its merry way, we got to close above 123-ish, that recent high that we saw, I think, in the fall of last year. But I sort of like Disney, and I haven't liked it for a while, but I sort of been warming up to it over the last few months. So that's just my take. Close above 124, and this thing can get into sort of, levels we haven't seen over the last couple of years.
Yeah, this one's interesting to me, Guy, because it was just in such the hurt locker for, the last few years, as you just mentioned. And so you're seeing some signs of stabilization in their streaming business, some profitability there. I just wonder if this stock can't get out of its own way. Bob Iger, the CEO, who's, come back to this company over the last, a few years ago, and now they're setting up some sort of, succession plan. Sooner or later, I just wonder if they kind of go the route of Comcast and they start thinking about how to unlock some shareholder value for some of the faster growing businesses and just kind of ring fence some of the other ones. But again, who knows? I think there's a gap there. I think there's a lot of enthusiasm about the name. If there's any change of narrative to the downside about the subscriber growth in their streaming businesses, I think this is going to be something that it's going to go back and fill in that gap towards 100. But this is also a name that I think a lot of folks would like to see to start to work and give you some sense that maybe some of these really difficult times in some of these media businesses, if they've navigated the changing landscape, are about like the worst days are behind them. Who knows? I don't have a strong view one way or another. Guy, what I do have a strong view on is how we have rebranded our other podcast. That would be the On the Tape podcast, the OK Computer podcast. We've kind of gotten rid of those names. We've gotten rid of those names. We have one podcast now. It's the Risk Reversal Pod. That is our audio first. We also obviously put the video of that on our YouTube channel. That would be the Risk Reversal Media YouTube channel. Guy, that passed 100,000 subscribers about a month or two ago. We're really excited about that. So Monday through Friday, Risk Reversal Pod drops in the podcast store. You don't have to do anything if you are already subscribed to On the Tape. You're going to get that pod, and it's going to be a 30-minute take it to the bank Monday through Thursday. On Fridays, we will have our longer form. These are investors, they are economists, they are strategists, and Guy and I, you are going to do that. We're going to have all the same old school contributors and guests and friends, but we're just calling it the Risk Reversal Pod. I have a great one. Gene Munster, Deep Water Asset Management. It's in the podcast stores this morning. We previewed the Google, Amazon after the close. So check that one out, Guy.
Yep. I think we're happy. We're streamlining. We thank everybody out there for getting us above that 100,000 mark. That is a bit of a line in the sand for the YouTube community. Apparently, as I looked up, we're in the top 0.6% of all YouTube channels, and that's thanks to you. And we're going to continue to sort of, do things that help the listener and the viewer and clean some things up and get tight on some other things and continue to sort of evolve into 2025.
Yeah, we're excited about that. We're making a lot of progress. We got a lot of momentum. We appreciate all of your support. So Guy Adami, you and I are going to be back tomorrow, 1:00 Eastern, with Liz Thomas of SoFi.
And real quick, Adam B says he likes the end of the day email too. So as I said, we're learning as we go as well. So we're evolving. That's what you want to do. You never want to sort of find yourself standing in place. You want to continually be moving. Motion, as they say, Dan, is medicine.
Yeah. And by the way, thanks for that. We have a great buddy of ours who's a great market mind. CC Lagador has joined the team as of Jan 1, and we're doing this great end of day write up. It's featuring a bunch of our content from earlier in the day, whether it be Market Call or the Risk Reversal Pod. We also have a link to the Market Matrix, which is a summary of the biggest stories of the day that you and I and our team curate. You don't have to listen to us talk. It goes into a voice spot. And so we got everything. It's a one-stop shop, a bunch of our charts, a bunch of our video, a bunch of our audio. So go to riskreversal.com and subscribe for that newsletter. You'll have it in your email box right after the market close, Guy.
Thanks, folks. We appreciate, as always, your participation. We'll be back tomorrow, as Dan said, with EYT. Enjoy the rest of your day. Enjoy these earnings releases, and we'll talk to you soon.
Talk to you.